Welcome to the Crypto and Blockchain Talk.
Hello.
Hey.
Guten Tag.
Aloha.
Hola. Shalom.
Hello.
Namaste.
Ni hao.
Privet.
Hello.
Salut. Yassas.
Salve.
Ciao.
Bonjour. Our podcast talks about the latest trends in the worlds of cryptocurrencies and the blockchain.
Hello, everyone, and welcome to this week's edition of Crypto and Blockchain Talk. And it's been a very interesting week so far because the price of Bitcoin and Ethereum has fallen by 15% and 20% respectively as of this time of airing. And this is looking like it's going to become a major correction. And I had to think about who we were going to be having onto the podcast this week. And I decided to get a brand new crypto expert. And he is from one of the only blockchains I would say I deeply respect. And who is that blockchain, you may ask? That blockchain is Kadena. And we'll probably talk about, well, we will definitely talk about Kadena in the middle of this podcast. But first and foremost, I would like to introduce Francesco Melpignano. Francesco, welcome to Crypto and Blockchain Talk.
Hey, Aviva. Thank you so much for having me. I've been a long-time fan and listener.
Well, I'm really glad to hear that you're a huge fan because I have to tell you, I'm a really big fan of your blockchain. Now, I also have to say that, and I know that you didn't even know this until I told you, but I actually interviewed Kadena, I think it's about 2 years ago. I interviewed Kadena and I was just in awe of what you guys are doing in terms of your blockchain. And we're going to talk more about that in a moment. And of course, one of the reasons why I was totally in awe of your blockchain is because you have people who are like OGs from Microsoft and people who used to work at the SEC. And I can only imagine what your background is. And we'll also go into that shortly. But I think first and foremost, what we're going to do on this week's episode is talk about really what the hot item on everyone's lips is. And that is this news that I opened up this podcast with, which is this major, what's looking like this major market correction in the coin market cap. So what do you think is going on here?
Well, Aviva, it's hard to describe what's going on the Bitcoin market always. We know the volatility that's there. We're all happy when it goes up, and then people start showing up when the market downturns like it does today. Seems like a 10 or 20% correction downwards stimulates almost more attention than a 100 or 200% gain upwards. Yeah, so the real noteworthy thing that happened, as a lot of you may know, was Coinbase's direct listing. And they listed, I think, with a valuation at around $100 billion, which is right around the market cap that Facebook listed at back in the day. I know that the Coinbase pre-listing, they were doing a lot of private rounds for like big institutional investors and family offices. And I know that around November or December, they were valuing themselves a lot more conservatively at $25 billion. And just because of the bull run that Bitcoin went through, they saw a crazy sort of uptick in their revenues because of the price of Bitcoin going up and how their fee structure works. So just the fact that that valuation privately went up from 25 billion to almost 100 billion pre-listing goes to show kind of what was going on in the market right there and then. And it's kind of one of the first times the more conservative institutional investors are exposed to the whole crypto world. So that in itself could easily be a catalyst for a Bitcoin price swing that we saw. And additionally, just the fact that their valuation was kind of blown up with the price of Bitcoin going up and the volume going up, it could just as easily go down next quarter, which probably wouldn't fare very well for the crypto market in general, because that's your average investor's easiest way to get exposed to the crypto market itself. And just the way their business model works, if the price of Bitcoin goes down and volumes of trade goes down with it, their quarterly revenue risks to be cut by a factor of 5 or 10. And then that, the valuation that they listed at may no longer be as sustainable as thought. And the regular stock market isn't as used to these massive price fluctuations that we are in the crypto world and volatility. So, that's probably the biggest thing that happened just around the whole crypto world.
There's a lot of things which are going on right now. And there's a lot of rumors which are obviously affecting what's happening in terms of the price of Bitcoin. Some aren't rumors, some are just hard facts. But, one of the main reasons why people are saying that Bitcoin has taken this dive is that, of course, Joe Biden has been making these significant changes to many laws. He's been overturning with executive orders everything under the sun. And his plans, of course, are consisting of implementing higher taxes to enhance, of course, the United States budget. And it turns out that the higher tax not only applies to big businesses and corporations and extremely wealthy individuals, but also to crypto holders. And Biden stated apparently today that he's planning to tax nearly 40% to individuals who are earning more than $1 million US. And we all know that crypto whales they very heavily affect the crypto market. And they saw this speech as one that made them change their underwear, because if you've got, and we all know the IRS are the people who brought down Al Capone. They are not a very forgiving bunch. And it's a fool in many ways, as we can also see by what's happening to John McAfee. It's a fool who tries to pull one over onto the IRS. And so there is one of the rumors going around of why the market has really capitulated to these tax initiatives being brought forward by Biden is because, of course, all the whales who are in the United States who do not want to pay capital taxes, they just went, well, forget this and dumped. So do you think that this is something that has weight to it? Do you think that this is one of the reasons why we've seen the Bitcoin price swan dive? And nothing that Francesco and I are going to say today can be ever possibly be construed as financial advice. You must do your own homework. You have to do your own due diligence. And if you do not know what you're doing, please go and seek out a professional financial advisor. Please remember, this podcast is in no way, shape, or form financial advice. So on that note, Francesco, we know that you're not Nostradamus, but what is your opinion on that topic, on that piece of news? Do you think that it is because of Biden that the market cap, especially in terms of Bitcoin, actually took such a solid hit? Or is it the fact that, crypto whales are all over the world and, not every one of them lives in the United States, but, is it the case that this could be one of the valid reasons why Bitcoin has taken a dive?
Well, I think the answer there is kind of take a higher level approach. The grand scheme of things, guys, I know we're all enthusiastic about crypto, about Bitcoin, about Ethereum, about everything that's going on in this world, but crypto is not that important at a macroeconomic level. And I think it's inevitable that when macroeconomic level events happen, i.e. the stock market dropping, that crypto will follow suit, and it will probably follow suit in a much more volatile way, as we're used to in these markets. So trying to link what Biden has said directly to crypto is probably missing an obvious step, which is what's that's doing to the equity markets and to Wall Street in general. This whole concept that Bitcoin is like digital gold and is totally uncorrelated from the stock market seems like a bit of a preposterous assumption. Not that Bitcoin isn't digital gold, and we can have that argument all day, but when macroeconomic things move, capital will want to divest. And crypto is volatile and it'll move fast. So you can see if the stock market drops 5, 10, whatever percent, we could probably expect crypto to move a little more than that. So we just need to take a step back and know that the valuation of cryptos in general are probably related to other bigger macroeconomic things happening in this world.
Well, one of the comments that you made at the beginning of the podcast was about people in general, and everyone's always everyone wants to see a rally in this space. And of course, though, you have those people who have Schadenfreude, which is they're kind of basking in the glow, I would say, of a dive in the market cap because they love to say things like, I told you so. And there are many, many. I looked on Twitter, and of course I read a lot of articles today, including from the Black Swan author.
Nassim Taleb.
Yeah, Nassim Taleb, who basically said you shouldn't be buying this crypto stuff because it looks like a Ponzi scheme. And I actually have his direct quote, and his direct quote says, Basically, there is no connection between inflation and Bitcoin, none. You can have hyperinflation and Bitcoin goes to zero. There is no link between them. So, there's a lot of people out there, as we all know, the Peter Schiffs of this world, and many people who obviously are looking at this as if it's almost, I want to say, the final straw. But Bitcoin has had many market corrections. This is one of many. So what do you have to say about, all these people who come out and say, told you so, told you so?
Well, everyone's entitled to their own opinions on what the validity of Bitcoin is and what the underlying value is to it. And I think there's actually a good way to look at a part of Bitcoin that people often overlook when they're thinking about the price, which is the amount of people that are mining Bitcoin. So at the moment, and I don't know the exact figures on my head, out of the top of my head, but I know that today it costs much less in electricity to produce a Bitcoin than the actual value of it is to buy. And if that doesn't scream overvaluation to you, it probably should. I mean, we went through, crypto winter when there were 2 or 3 years where miners were mining Bitcoin at a total loss. It was costing somewhere between $10,000 to $20,000 in just pure electricity costs, forgetting about equipment, to mine a Bitcoin that was worth between 10 and 15, maybe sometimes even less. So that should probably be a good metric for when people want to buy in and out of the coin. Because, eventually we'd hope that this price will stabilize over time as the miners increase, and the amount of money that goes into electricity to produce a Bitcoin will start to resemble what the actual price of a Bitcoin is. But yeah, I'm not sure how correlated all of this stuff is, but it's just definitely a metric that people overlook when they're looking at the price of Bitcoin. They'll more likely go after what some influencers is saying on Twitter versus looking at real numbers that makes some sense.
If we're going to talk then about influencers, at what point do you think Elon Musk is going to have to change his underwear? I mean, he bought at 45. Bitcoin is still, it's had a significant gain since the beginning of the year. And obviously it's had massive gains over time, and that's an obvious thing. But at what point do you think crypto whales like Elon Musk, who of course invested $1.5 billion of Tesla's corporate treasury into Bitcoin, at what point do you think he's going to start wondering if he made a mistake? Or do you think he'll ever think he made a mistake? On one hand, with people saying, okay, well, the reason why the price of Bitcoin and of course reflected by the entire market cap of all the coins has taken this downturn is because whales dumped what they had. But I mean, really, do all whales dump at the same time? And the reason why they're whales is because they can afford to take these kinds of risks in the most part, and they can afford to hodl. So at what point do you think someone like Elon Musk is going to start maybe getting a little shaky in his boots?
I think Elon Musk is well known to be one of the longer term thinkers around. So whatever happens, he's probably going to be right in the long run, which I think is what matters. And if the price of Bitcoin goes down and he is the believer that he is, he should be bringing down his dollar cost average and buying more. Let's put it that way.
Well, maybe we should look and see what MicroStrategy is doing. They buy the dips and the rips. But, I mean, there's a lot of people who are, the naysayers who are jumping on the bandwagon, like we already discussed. But then you still have places, as we talked about in not last week, but I think the week before his podcast, Miami are looking to give an option to their staff to pay them in crypto. And it looks like Louisiana is actually passing also a resolution to encourage their state and local governments to use Bitcoin. And this resolution came out just a couple of days ago. And they are pushing for both, like I said, state and local governments to consider ways that can help them benefit from the increased use of Bitcoin and the technology that is behind Bitcoin. So I guess they didn't know that was called the blockchain or blockchain technology. And then, of course, the mayor, Scott Conger of Jackson, Tennessee, also has started to roll out plans for using crypto in the city. And he said that the city is exploring giving their employees, just like in Miami, the option to be paid in crypto, as well as also having the city mine Bitcoin and keeping it on the city's balance sheet. It's interesting, this dichotomy of thought processes that are going on even while this volatile marketplace is in play. I mean, don't you think that's incredibly interesting that these massive places, these cities are looking at implementing a cryptocurrency or cryptocurrencies, because I think I've also read that some of these places are looking at not just Bitcoin, but Ethereum and some of the other top 50s, going into play there. But don't you think it's incredibly interesting that they're still rolling these things out knowing that the marketplace is volatile?
Totally. And I think here there's two main things going on. The first one is paying employees in crypto. And then the second one is keeping crypto on a city balance sheet and potentially mining it. Mm-hmm. The first one seems a little bit irresponsible. As we saw in this past week, paying employees or receiving payment in a volatile asset, although there could be some promises of this asset going up in price, et cetera, is a very risky endeavor. If I need to pay for my family's meals at the end of this month, I can't afford to be holding a volatile asset like crypto. That just doesn't make any sense to me. But the part that does make sense is potentially leveraging blockchain technology to make currencies that are stable, such as USDC or whatever the city wants to issue, and potentially paying in that. But just people need to be paid in a non-volatile asset. There's bills to be paid, and those bills are paid in dollars. And so you can't totally rely on paying people in a volatile currency, or, it's the equivalent of saying, hey, I'm going to pay you in some random stock, right? Like, are people really attracted to that? If you pay them in the equivalent in fiat, they're free to go on some exchange and buy their own Bitcoin as an investment. But I think it's the misunderstanding of what Bitcoin is and what these currencies can do. But the underlying technology can be used for a lot of great things. Then the second part about mining, I actually very much agree with that. And it also ties to the whole, is Bitcoin mining bad for the environment, all that sort of stuff. So municipalities and cities and counties or states, they probably have a good deal of say over what happens in their power generation plants. What we know, and is pretty much a fact, is that around the world, 10 to 15% of all electricity produced is totally wasted, because at the moment it's produced, there's no demand for it, and it's more expensive to turn these power plants on and off based on demand than it is to just create the energy and waste it. And that's because, batteries aren't and probably will never be in the technological sort of environment where it makes sense to store all this excess energy. So one thing that could make sense is to use this excess energy to be mining cryptocurrencies. And this is sort of a novel idea, that this excess energy that's created can actually be used to in turn create something of value. So instead of actually putting a strain on our power grids and on the world power supply, it could actually help, in a way, make power cheaper and take advantage of energy that is totally wasted. This is a broad view and a dream, but I think governments will eventually wake up to this fact, because it's such an easy way to turn wasted joules into dollars.
Well, absolutely. And the reason why I thought about you coming on to this week's Crypto and Blockchain Talk, it's actually quite funny because, you are with Kadena and your people, I say that as if you're a tribe, your people are responsible for creating not just the Kadena blockchain, but before the Kadena blockchain, the team responsible for Kadena built out the JP Morgan blockchain.
Yeah, so I'll give you a little background on the team. So our two co-founders, Will and Stu, they both worked together at the cryptocurrency group at JP Morgan. Stuart was the lead of this group, and Will was his first technical hire and lead engineer. And Stu's background was, before that, being the head of the cryptocurrency group at the SEC, which has permeated in all our company policies and our attention to regulation and always staying on the right side of things. And also our caution on doing everything. And the way we've launched the network, and done our marketing have been very much adhering to any rule that's been posted, whether we agree to the rule or not. We've always erred on the side of caution. And Stuart, his background before sort of leading the cryptocurrency group, he wrote a bunch of the code that's still running right now at JP Morgan and functions as their exchange trading backbone.
Wow.
So I think we have a decent amount of experience both on building massively scalable systems that can support global economies and also having the right eye on what's going on in the regulatory landscape.
I knew that about Stuart because, like I said, I interviewed him. And when I heard about Louisiana and Jackson, I thought to myself, hey, maybe Kadena should go and pitch their blockchain to these cities and get them to use KDA to pay their employees. Because, I really am a big fan of your blockchain. I just can't believe, I'm just going to be, completely honest. It should be up there in the top 10. Not only because the code is so solid, but also because what your blockchain can actually do in terms of the scalability, this multi-chain function. And I know that you guys are really just doing things that many people are talking about they're going to be rolling out, but you guys are already doing it. And it's like, and you're not really making much noise about it. You're like, I'll see things all the time because obviously my finger is on the pulse in this space, being that I'm a news provider. But I look at things all the time and I'm like, wait a minute, Kadena already does this, don't they? And then I I'm like, yeah, why aren't they coming out and saying, hey, we already do this stuff, guys. We already have 480,000 transactions per second. I was just reading about some blockchain who was like, yes, and I'm not going to name them because I think they're pretty cool guys too, but they're like, we can reach 100,000 transactions per second. I'm like, wait a minute, Kadena can wipe the floor with them. So do you want to just explain a little bit more about, can you give some of the USPs of what unique selling points, that USPs, that's what that stands for. Can you give us some of the unique selling points of what your Kadena blockchain does?
Yeah, of course. And I think the main point here is that we've managed to scale proof of work. And how did we do that? We have a system that scales in a horizontal fashion, which means that we're not limited to the throughput of a single chain running a proof of work and mining algorithm. The way Kadena works is that we can have an arbitrary number of chains running at the same time. At the moment, we're running 20, and we scaled in production from 10 chains to 20 chains this summer, showcasing that we can scale now to any number of chains to meet any demand that's coming in. And why is that important? It's important because all the problems that we're seeing now with Ethereum are simply congestion problems. All the gas fees and all the negativity surrounding, the cost of using Ethereum and some of its downfalls and even its environmental concerns come down to the fact that the architecture of the chain itself is not made to scale. It's well known in computer science that how you scale a massive computation system is to parallelize processes. And that's what Chainweb achieves. And it achieves that with very, very simple math. So all that's going on is basically that each chain holds some cryptographic information, which is the header of, in our case right now with 20 chain configuration of 3 other chains. So that means that the same principle of Bitcoin applies. It's not just one chain running at the same time like Bitcoin, but there's multiple chains running at the same time that are all cryptographically linked, which means that if a piece of data gets changed on any one chain, all of the chains in the system break. So all the great stuff and the innovations that came from Bitcoin stay and hold true, especially the security of proof of work mining. All these new algorithms that we're hearing, whether it's proof of stake or proof of some other random thing. The main thing that shows up in these white papers is that around two-thirds of the network need to be honest for the network to, continue to be valid and for the system to actually work. But let's forget about this whole philosophical side of a proof of stake versus proof of work. All these proof of stake chains are limited in throughput, and that's simply because of their architecture. Like Ethereum right now is running a single chain, and that's why there's significant wait times to get into a block because Ethereum found pretty good product market fit, and there's many people that want to interact with it. But that's not saying that one of these new generation chains that promises higher transactions per second while also potentially, reducing security because of the lack of mining and new consensus algorithms, does have an upper ceiling on what their scalability is. So say we know that the promise of blockchain is going to become true in the next 3, 4, 5 years, and the number of people that want to use blockchains of any sort increases, it means that these chains will be in exactly the same position that Ethereum is at today, where there's just too much demand for the number of transactions that can be processed by that chain in that one single time. And what Chainweb does is it's able to increase the number of chains to meet any demand, which means that there will always be block space for transactions coming in. So as the demand for our chain inevitably goes up and all of the vision that our space has been pushing for the past 4, 5, 10 years. Like huge companies like Visa or even the entire stock market will want to settle their transactions on blockchain. Only a chain like ours without an upper scaling limit will be able to handle that type of throughput.
So as you know, this podcast is dedicated not only to people who are very well seasoned in terms of blockchain technology and everything to do with crypto. We also have a lot of newbies who listen to this podcast. So can you just go over one more time what that actually means to have 20 different chains and how they're connected? Break it right down.
Oh yeah, totally. Maybe let's start with the problem of gas fees on Ethereum today. The reason that gas fees have spiked so high, and we saw the first sort of preview of this in the CryptoKitty era, I think it was 2017, is very simple. There's only one block that can be processed at a single time, and say that one block fits 1,000 transactions in there. And that's totally limited to the amount of transactions that can be processed in that one given time, because not more than 1,000 transactions can fit in there. So the second that there's more than 1,000 people trying to get into that block, people start to compete on how much they're paying in fees in order to get into that block. So it's just inevitable, and it's almost like a self-written curse, that as network activity goes up, gas prices inevitably fall. So what Kadena allows by scaling the number of chains means that there's always going to be enough block space available for incoming transactions. And say right now we're at a 20-chain configuration. Already, if each one of those chains could process 1,000 transactions each, we'd already be at 20,000. But say if we scale from 20 chains to 100, that will give us 5 times more space and can handle 5 times as much demand without raising any gas fees of any sort. And that's really the promise of Kadena, is that no amount of demand will ever cause gas fees to spike. Whilst the promise of a lot of other chains is that, yes, the gas fees are lower than Ethereum, but the gas fees are lower now and today. Once that chain gets congested and a bunch of people start using it, because we're still in the very, very early days of crypto, let's not kid ourselves, they're going to have the exact same problem. And, we have delivered on this, and we've scaled our blockchain from 10 to 20 chains in production, which just goes to show that as soon as demand spikes for our chain, we're ready to fork to any number of chains to meet this demand and keep gas fees low forever, not for the time being.
I know that a lot of companies use your blockchain, but with a solution like this one, are you guys going to then start going into the DeFi space?
Yeah, so we've actually been working internally on a DEX for the past several months. It's called CADEX. We have been delivering bits and pieces of it for the whole year. We launched Bounty Swap, which was a mainnet version to test out sort of the assumptions of the DEX with the familiar Uniswap AMM model. We saw great success in that with our community to test it out and find any types of bugs. Luckily, nothing was found. So now we're kind of getting ready to take the next step and repackage CADEX and launch it to stand on its own feet. One of the great features of CADEX is that, yes, it lives on Kadena, but because Kadena is working tirelessly on bridging to many other blockchains, it's going to work for an arbitrary amount of tokens from any blockchain ecosystem. We're really looking forward to that launch, whichever way, shape, or form it's going to take. We're 100% behind the technology, and we know that the DEX market needs something that actually scales whilst keeping decentralization. And I think with the architecture of Kadena's underlying blockchain, we can be the ones that deliver on that promise.
Well, so you just mentioned actually something. You said AMM, which stands for Automated Market Maker. Can you explain what an AMM is?
Yeah, of course. So AMMs are what power DEXs like Uniswap. So maybe to explain AMMs, it's better to start from how a regular exchange like Coinbase or Binance or any of these other well-known exchanges work. They work with an order book model. So basically, they match the centralized company, whether it's Coinbase, Binance, or whoever, match buyers and sellers and charge a fee for that matching. The beautiful thing about AMMs is that you no longer need a centralized entity to match these orders in order for exchanges take place. So what happens on Uniswap is essentially it's a trustless way to exchange between X different number of parties. Because in the case of centralized exchanges, you're trusting Binance or you're trusting Coinbase with the crypto that you deposit on there, that they're making truthful matching between the buyer and the seller, et cetera, et cetera. So how AMMs work is by constant product. So essentially, what's happening under the hood is there's two sides to an AMM. There's the regular side that everyone's familiar with, which is the swapping side, where a user can come in, select that they want to trade, USDC for USDT, or whatever pairs they want to trade, and they pay a small fee on that. So the end user that's swapping has a fairly similar experience to the end user on a centralized exchange, which is great because actually the UX of using a centralized exchange is something that people are fairly familiar with and is a fairly smooth process. But then there's the whole other side, which is where is the liquidity coming to finance the swap that the user is about to do. And this is the beautiful part about AMMs, in my opinion, is that there's a whole realm of LPs, liquidity providers, which essentially put up a pair of a token in a given ratio. So say I want to put up a pair of Ethereum with a stablecoin. Right now, Ethereum is worth around $2,000. So you put up one Ethereum and 2,000 of the stablecoin, let's say it's USDT, inside that pool. And what happens when I put that money inside that pool? That money is there locked up, and you can't access it in that moment in time. And what the purpose of it is to provide liquidity for the swaps to happen. And then why would people want to lock up their money in a pool in that manner? It's because they can distribute to themselves all the fees that the swappers are paying. So say an end user, they come in and they swap 1 ETH into USDC. They get charged 0.3% of the trade value, and then that 0.3% gets distributed amongst the people providing liquidity for that pairs or the LPs that I mentioned beforehand. And it's really just a beautiful system where it takes no intermediary at all for trading and swaps to happen, making everyone happy because the swapper has an easy way to trade their coins and the LPs can lock up money that they're probably not using and earn interest on it. And this was one of the fundamental bits of, I guess they call it Legos of DeFi, that has made this whole realm of new applications possible.
You're going to go then head to head with the likes of Uniswap and PancakeSwap. And, I was just actually looking at the market cap for DeFi projects, and it actually hasn't been hit really that bad with this latest correction. Yeah, it really doesn't look like it's been hurt as much as the other ones. And then, of course, there was this news that came out that, of course, PancakeSwap has eclipsed the Ethereum network in 24-hour transactions. Did you see that article?
I did, actually, yeah.
Yeah. What do you have to think about that?
Just taking a step back about what you said a second ago about, all these competitors, Uniswap, PancakeSwap. In order to scale, and we're talking about Uniswap V3 here, that's supposed to be launching at some point.
Yeah, anytime. It's like any minute now. Yeah.
Yeah, apparently that's when they're going to launch. But it seems like they've taken an approach that in order to scale, they need to move off Ethereum itself and live on layer 2. And that's definitely a compromise to decentralization because layer 2s are de facto fairly centralized ecosystems. And certainly they could be centralized or pseudo-decentralized, but will never be as decentralized as Ethereum itself. So, this gas concern has come to the forefront of everyone's mouths. And I don't think anyone has really solved it the way Kadena has by scaling their layer 1 network.
You guys are a layer 1.
Demand.
You guys are a layer 1 DeFi solution.
Right. So Kadena is the layer 1 that CADEX is built on top. And then I want to continue the conversation is also that another approach to scaling is kind of what Binance did with their BS chain, which was essentially just take Ethereum itself and turn it into a more centralized proof of authority sort of blockchain system that gets rid of the mining but significantly centralizes the whole operations of the chain to the point where Binance is probably in control of the vast majority of the transactions that can go through there, et cetera, et cetera. And for as much as they found product market fit quite fast with their new chain and porting over projects from Uniswap, we saw the other day that even that model that gets rid of mining hit a significant throughput limit. I saw like a Twitter post, I think it was from the official PancakeSwap account, where they said use more gas. So what's evident there is that even these and I don't think you can see my air quotes, more scalable chains have a throughput ceiling limit. So it's very, very important for the base protocol that any DEX is built on, if it's going to support any of the volume that people think this will support in 3, 4, 5, 10 years' time, to be inherently scalable and be able to increase throughput to meet any demand for it.
I'm really looking forward to seeing what your DeFi product is going to, what your platform's going to look like. When are you looking at rollout?
Very soon. So the tech is there, and watch this space because we'll be launching soon. And we're really the only platform that will be able to scale a DEX that lives natively on a layer 1 to meet any demand, whether it's today, tomorrow, or in several years.
Well, so I have to ask you this, with this down market happening right now, does it matter when you launch a new product like a DeFi solution on a blockchain? I mean, are you guys going to wait to see what happens, or is it just like, look, we have confidence in not just what the entire cryptosphere looks like, but we just have confidence in our product, and it's ready to roll, and it's going to roll?
We have confidence in our product, and a lot of confidence. And we know that this stuff is going to do well in the long run, regardless of what the market is doing now. Probably in our interest to not sit here and wait for other factors to align. We're just going to plow through our roadmap. Whatever happens with CADEX and like potential token sales and that type of stuff, we're here for the long term. We're not here to care about how much money is raised in the short term. We need to restart that.
Well, I will tell you this. I would love to have you back on to talk about your DeFi solution. I will be following because, like I said, any group of people who can create the JP Morgan blockchain and work at the SEC and have this amazing solution, my eye is on them. And my eye is on you, Francesco.
Whoever is interested and wants to join along or wants to learn more, please feel free to reach out at Francesco at Kadena.io.
Just so that everyone knows, the URL for Kadena is Kadena, Kadena.io. So that's if you want to look at the Kadena website. You will obviously see Francesco on that site if you look at the team part. I will also put the link in the description of this podcast. Francesco, thank you so much for coming on to Crypto and Blockchain Talk. I'm serious. I would love to have you back to talk about your DEX, especially when it does launch. So will you come back on?
Aviva, anytime. It was great to be on, and I'm looking forward to potentially coming back sometime soon. I'd love to have a bit more time to delve into the technicals of how the DEX works and how it's definitely the future of what's going on in the space. But thank you so much.
Oh, listen, the pleasure is ours, seriously. And I think the listeners will also really appreciate your deep dive and explanation about many of these terms that they hear over and over within the DeFi space. I'd like to thank everyone for tuning in to this week's edition of Crypto and Blockchain Talk. Please tell all of your friends and family to download our podcast on one of the many podcasting platforms. The whole entire list is available on cryptoandblockchaintalk.com. There's also some very exciting news, and I cannot tell you it yet, but we're going to be launching very soon on a major global technology brand. So I can't say any more about that this week, but I'm hoping next week I can tell everyone here. And of course, that edition will also be on our website when that does happen. Furthermore, if you want to get in touch with us, of course, you can get through on one of the social media marketing platforms that we are listed on, such as Twitter, Facebook, and Instagram. But more importantly, we love to hear from you directly. So please remember to email us at education@savvydigital.com. That's education@savvy, SAVII digital.com. Furthermore, these podcasts and music and news are available 24/7 on our sister radio station, Crypto 24 Radio. That's crypto24radio.com. Again, thank you so much for joining us. We know that you have a huge amount of choice when it comes to who you listen to, and we really appreciate it when you choose us. So again, thank you so much for tuning in. Please be safe, take care, and goodbye for now.